Classic Bob Seger song laments against the wind. I'm older now, but still running against the wind. Both retirees and our industry are pressing against the headwinds and resistance of retirement funding need and a more restrictive product for us to offer. Now, the good news is that the reverse mortgage industry, and yes, the HECM product, have proven their staying power, having endured one of the worst housing crashes in history, an economic crash, and also numerous product changes. But not to be forgotten are increasing home values, which have buoyed our production this year with an increase of 15% through November. But the next headwind will be felt once HUD enacts the financial assessment in their effort to reduce the risk of borrower defaults and subsequent claims against FHA's insurance fund. But are some of these recent developments really a blessing in disguise? Columnist Phil Hall in the National Mortgage Professional magazine says yes. A new oversight regimen may finally help to erase the lingering doubts surrounding the product. If we look honestly, the true obstacle for market growth is not the 15% reduction in principal limits, the elimination of the standard fixed rate or saver, or even increased insurance premiums. It's our industry's reputational woes. Hall cites one originator's experience when he tried to explain the benefits of the reverse mortgage. I asked her how much she knew about the reverse mortgages, and she replied, "I know they're bad." He asked, "What's bad about them?" And she said, "I don't know. I just know they're bad." Then he asked her again who told her that, and she said, "Someone at church told me." Now, with a scant 2% of eligible homeowners having taken a HECM loan, it's clear that perception bias is our biggest challenge. Now, combine that with a misinformed public and lawmakers who see the product as weakening our federal housing program, one can now begin to connect the dots. And this is where stricter lending guidelines and product overhauls, like the Reverse Mortgage Stabilization Act, can in fact work in our favor. Peter Bell, president of the National Reverse Mortgage Lenders Association, said this: "The changes should help drive consumer behavior. People will be able to take out the money they need and then have the line of credit. It will be better for everyone." Les Kramsky, a real estate attorney in New Jersey, cites improved reverse mortgage disclosures and also alternate solutions being presented during the HECM counseling as further evidence of improving the product's reputation. Now, while inaccurate and misleading media pieces have panned the HECM program, some major programs and publications have begun to turn the tide. Recent articles in the Wall Street Journal have encouraged their readers that are more affluent to take a second look at the program. Another possible improvement to the program's reputation would be more banks and credit unions adding the reverse mortgage to their product mix. With the exits of Bank of America and Wells Fargo, we have lacked the advantage recently of brick and mortar banks fortifying the HECM loan's credibility. Yes, our industry faces the headwinds in the coming year, but overly fixating on product change will distract us from our largest and potentially most profitable task. That is to improve the reverse mortgage's public reputation. Now, what are your thoughts? Do you see the program's reputation as our chief hurdle, or is it more of a restrictive product issue? Leave your thoughts in the comment section below and have a great week.